Thanks for being back. In my video yesterday, I talked mostly around the topic of how to read news in the media surrounding fear, uncertainty and doubt and the risk of investing in China. And I basically mentioned, there are positives around it, there are negatives around it. And in the end, it comes down to risk management, which is kind of the essence of investing in general. So in this video, I want to take it further and make it actually quite hands-on here. I want to give you a kind of a little framework here about making basic due diligence and managing risk, and talk about three main factors. So here the China risk, valuation risk and execution risk, and talk through some concrete examples from the Chinese stock side like NIO, Luckin Coffee, Alibaba, Pinduoduo, Xunlei, ZEPP, the educational stocks YouDao versus TAL, as well as TIGR and FUTU, but also some Western names just like Tesla, Apple and Farfetch. Because what I like to stress here is also the fact that this is not only affecting Chinese stocks, but also actually all of the stocks that you are possibly investing in. So let's start with it. And as always, this is not stock trading advice. This is only, from my experience, how I'm personally doing things. And then possibly you can learn something from that and also apply it. So first of all, the big topic this week has been the China risk. People say, how can you trust China? China has legal issues when you invest in those companies. For instance, the so-called VIE structure, which is basically a holding format and has some risks aligned with that. And then also what we just saw escalating is the regulatory risk as well as some sector risks. So I also want to give you some ideas which sectors in China could actually be at danger to that. And as someone who is actually mostly investing in Chinese stocks, so that's my largest part of the portfolio, what I'm looking for the most is that I like to identify opportunities in which China is leading or has some interesting stuff at the technology side and also the business opportunity aligned with that. And on the other hand, is not at risk of being disrupted by new government policies, if that's possible. And one big thing to note about that is that you kind of need to get a little bit of an understanding of Chinese politics, Chinese history, and also I would call that Chinese values and how things are prioritized in China. And I mentioned once in the last video this big picture of a harmonious society, which I think is really the most important thing to understand in which sectors China really wants to have a strong hand by the government, for instance, which we saw in the past is, for instance, in the area of FinTech, everything that has to do with financial risk, so also the crypto space, but also, for instance, Alibaba tried to venture the IPO, the Ant financial IPO, into an area which also had to do with micro lending, for instance, and that is closely connected with stability in the country. But there are other areas as well, as we now see with education. So this crackdown has been on education stocks. Not the stocks in specific, actually, more like the sector needs to have stronger regulations in the views of the government and the regulators. And why is that? It's because the pressure on Chinese students has been enormously in the past. So there is really a big fundamental pressure by, for instance, the parents also in China for their kids to succeed and to have the highest chances to go to the best universities, have the best education. And that has been exploited by corporations, by some non-listed companies, maybe also some listed companies. And frankly, it's been also exploited by foreigners coming to China, teaching English, without having any credentials, without having a formal education in teaching, for instance, but it was possible in the early years to go to China. All you need to do is speak natively English, and then you're an English teacher, and you can make lots of money, like for instance in YouDao, which is like a district of Beijing, where all of the universities are. There's lots of foreign students like me a couple of years ago who can just go and pick up a job and teach Chinese people English, and you can make a very decent salary on that. So I know people who are living there who are earning more money maybe than others in very formal corporate jobs. And yeah, this is also maybe an area which has put too much pressure on society and was unregulated in some regards, and that's also possibly the reason why those companies, those educational companies in China, have been booming and made quite a bit of money, but also quite a bit of venture capital was flowing into this area because there was a big opportunity there. And that's also why lots of marketing dollars have been thrown at colleges, at students, and not all of these offers have been good for them. So that's why it's essential for the Chinese regulators there to step in. And actually now the first drafts or the actually real news now has come out with the actual regulation and how it's going to look like. So I'm also gonna talk about this in the next step, but this is like the broader macro here, right? You need to understand what are crucial fundamentals to China in which it's better not to invest in companies who are possibly exploiting a trend there. And how can you know which are the sectors at risk? Well, a good understanding could be, for instance, the 5-year plans, which China is publishing. These are getting translated into English as well. Possibly I need to make a video about that in the future, but basically they outline where China wants to be leading in terms of technology, and also what are the concrete plans, sometimes even like straight out KPIs, how much money is going to be invested and so on. And then this gives you a good view of interesting sectors and business opportunities also aligned with that. And then obviously from the societal side, you also need to understand which one of these are actually crucial to this harmonious society in terms of if the checks and balances are off in this regard, then possibly the regulators are going to step in. And we have seen that now with the BAT, Baidu, Alibaba, Tencent and Meituan, for instance, in some regards. These tech companies, they have exploited in some regards competitors in terms of advertising. For instance, they have been advertising or making use of data in a way that wasn't covered by law, and so the regulators are now stepping in because they don't want to see those kind of exploitations happening that can actually disrupt the society on a larger basis there. So for instance, in China we had the issue around working long hours, 9-9, which is 9 to 9, 6 hours a day. That's kind of the working ethos that you've been seeing in startups, in big corporates, at Tencent, at Alibaba. And now these are actually scaling down and back a little bit because it's having put huge pressure on Chinese white-collar workers and university graduates, which have been, working really tough jobs, and obviously this is all resulting in people being not happy about that, and that's when finally the regulators will kind of start and paying attention to that. So that's more the macro thing here when investing in China, and where you can get some orientation of which sectors might be good. I possibly have to do actually a separate video on that. I cannot cover all of this in detail for now, but this is just to give you an explanation on those recent events and where to see opportunity and also issues in China. But I will talk about this more in depth now with some of those companies that I'll cover here. But before that, that was just now the China risk. Let's now also talk about two more factors to consider in such a basic due diligence, which is the valuation risk. So how high is a company already valued? And also what is its downside as well as the upside? That's something important to assess. And then also the execution risk, like how likely is it that this company can actually execute? How likely is it that this company can actually execute and be successful on the vision that they have laid out there? So these are three most important things to watch as an investor before making an investment, or to reassess while making an investment. But now that's been kind of theoretical here. Let's dive into some of these names now. to work as an example on all of these three aspects. So maybe let's start with NIO. NIO is obviously an EV player, and NIO is a consumer brand, so direct to consumer touch points there, and NIO has also those software side of things and also the data collection side of things. So you could say, talking about the China risk, yes, first of all, NIO is a Chinese stock, so they have these legal issues attached to it, so it's in the VIE structure, and basically how I think of that is that the VIE structure is a workaround in order to make foreigners being able to invest in Chinese stocks. To me, yes, it is a risk, that's for sure. But on the other hand, I always ask myself, what is the downside to this VIE structure? Mostly it's like people say that in case of things turn sour, that you possibly wouldn't be able to have really access to the assets and the holdings of this company in mainland China. But for me, this is kind of a non-issue here because, take the cases of, for instance, Wirecard in Germany or Enron or let's say Nikola. If you are invested in these companies, yes, you have actually better legal rights of enforcing your rights, but in the end, what will it really help you? Most of the times when fraud is actually happening and it's happening on purpose, most of the time investors are really left with nothing. So that's why investing in stocks in general, but also in Chinese stocks in general, is of course risky. You can lose all of your money in that. And so the legal aspect is just one side of it, but I generally, and that's just my views, I don't rely on will I be able to join a lawsuit and get back parts of my money. I'm actually really not counting on that. So let's talk about the regulatory and sectoral risk for China there. And well, the automotive sector in China is of strategic importance for the Chinese government. They are kind of leapfrogging technology there. They know in the internal combustion engine cars they cannot lead anymore because that's basically where Germany is leading, has the best technology. And China knew this from a very long time, so they invested heavily in becoming the best car manufacturer for EVs, but also in the battery technology. Most of it is really centered around China. They have a huge supply chain in this area, also patents and know-how and the scale, which is important. So that's really a sector which has lots of upside in China, and also the strategic backing from the government. Does it have sector issues in terms of could there be a crackdown in this area? Well, not so much on the automotive side, I would say, but maybe on the data and privacy side. So yes, I would say if NIO wouldn't be compliant, for instance, in the way that they are collecting data in their app, then there could be the danger that they could force, let's say, even the deletion of their app in the App Store. But that's so far they haven't been called out for that. So there has been already a list issued by the MIT which names, I think, around 100 names of Chinese apps that are facing the issue of possibly being deleted from this app store. Interestingly, one of them is Amazon China, which is collecting user data without the consent. So these apps need to rectify the ways they are adhering to the law. They need to become compliant, which I think in most cases will be not an issue. But this is something which could be a risk for NIO there. Another risk is maybe connected to Didi, that NIO is obviously, of course, also collecting geodata where people are traveling. And there's actually a law in China that all of the EV companies, including the foreign ones, they need to send their geodata to, I think there's a central institution for that, which is kind of logging around that. So there's actually a privacy issue with that in China, but it's applying to all of the car companies in China, and I think it has to do with something, I would need to look that up again, but it's something similar to what we also have in Europe actually, which is that for in case of an emergency, there is this little button in the car which you need to pull, which is sending automatic a signal to the rescue forces that they can know where you are, and send a team and so on. So that has also been implemented in Europe. I think something similar like that in China, but basically, yes, there is user data gathered, and it's not only in the hands of those private companies, but also needs to be submitted to institutions. So there might be a case or a threat at which, well, for instance, Chinese government officials are using some of those cars, and there might be an issue around the privacy of those leaders. So I think that was also parts of the issue around Didi Chuxing, which is of course gathering mass data about where people are traveling, and parts of these may actually be official government officials, which well, in that point in time it becomes important information, because if that is, for instance, given to foreign institutions in order that they could make sense of it, then of course that becomes a national security issue. But I would say that case is quite tiny here. It is an existing threat, but I would say the likelihood is quite small, and all of the car companies would be regulated in that way. So it's not a neo-specific issue there, and in that regard the China risk is actually quite subtle. For the valuation risk, the current market cap of NIO is trading in relation to where growth companies and also software-sided companies are trading. So NIO is being valued more than an automotive manufacturer, but having also this software business, having also e-commerce functionalities and so on. So that's giving NIO a higher multiple on the current sales, and also because of the growth, lots of projections into what this company will be in the future. So NIO is now roughly a $70 billion company, so it's not a small cap anymore, and still it has tremendous upside if NIO can continue on their vision of becoming a larger player and also diving into different revenue opportunities. So NIO still has a big upside here in terms of a future valuation, but at the same time it also has a pretty big downside coming to the next risk, which is the executional risk. NIO may well be not able to execute on their plans, and may not be able to sell as many cars, may not be able to thrive at autonomy future. They may not be able to sell many products through their e-commerce channels and stuff like that. So in that way, and also with the macroeconomics about how growth stocks are being valued, in that regard, NIO has actually quite some big risk here in terms of being valued lower for maybe just a certain period of time, but also in the future in terms of if they would fail. But on the executional risk, what can be said is that NIO has now proven within the last months that they are really kind of executing well on the goals which they are officially announcing. So also if you look at the management team with Li Bin, with his history, and also the people which they are hiring, for instance, in the field of AI, with Ren Zhaojing from Momenta AI in the area of autonomous driving and so on, with now the new board director being one of the most famous businesswomen in China and stuff like that. This gives you a better understanding that this company is not only making big plans, but it seems like they are really working towards actually becoming that company in the end, right? So these are the kind of the thoughts that you would like to make also on your own when doing due diligence, and if there is a red flag in one of those, then you would need to kind of manage your risk and say, well, I cannot invest as much in this company as I could if there wasn't a red flag at all, right? So that comes down to risk management. It doesn't mean that you don't have to invest at all. An example for that is Luckin Coffee. I personally have invested in Luckin Coffee despite knowing that there are issues. I knew around, for instance, the short seller report about this company. I knew about those accusations, but it has also checked some marks in the area of that the valuation upside was there, and also that they were really executing well in terms of building all of these storefronts in China in a very short amount of time. But of course, there was also the big China risk about it. Yes, it could be a fraud. Yes, there could be wrong numbers. Yes, there are legal issues around that. But what did I do? I ignored that. I made a kind of a short-term bet on that and invested, but only a tiny amount. In the end, long story short, what happened is, yes, there was fraud. And at that point in time, what did I do? Well, knowing the company a little bit deeper on, the fundamentals in terms of how much revenue they make and so on, I doubled down on my investment in that time when it was around $1 to $2. So my average cost was coming down much more. And then, to officially also disclose that, when it was around $8 to $10 again, I sold off my position. I booked a profit there, and kind of stopped investing in this company because I now see that the upside of this company is maybe not that much. Let's jump to the next example, which would be Alibaba. And what is interesting there is, well, it's one of those stocks most in focus with the China risk aligned, right? It's one of those companies, maybe because of the IPO and also the person of Jack Ma being really at target here of the Chinese government, but also of the media reporting around it. And that has resulted, if we look at the valuation risk, that the current market cap is actually quite low, to be honest. Personally, I'm not invested in this company, but judging from the relations to how much gross merchant volume they are having, like how much sales they're having, and how much they're earning towards how the stock is being valued by the markets, there's clearly let's say a gap between where competitors would be valued usually, but that's because of all of this fear that we have here around that. But on the other hand, like the execution risk, this is really low, right? You have a really good management team, and coming back to the China risk here, yes, there are some sectors or business streams that are at a bigger risk here of being targeted by government policies. For instance, now, of course, the FinTech area, in which Alibaba with Ant Financial is very present, and which is possibly not the best idea to venture in as a private company then, and trying to kind of circumvent existing regulations and also existing business models there. But that's where Alibaba is active, and that's why that's certainly a China risk here for Alibaba. But besides that, you need to think also like on the bottom line, how much of that business will actually affect Alibaba's sales? And I would personally say possibly the impact isn't really big. For Alibaba, even though there is, if there is a bigger crackdown and more tight regulations around e-commerce, they have the biggest platforms, they will strive, they have all of the clients, lots of the brands want to sell there. There's no way around that, right? So it doesn't matter if, for instance, the competition rules are getting enforced even further. This company will still earn good money and possibly grow even further. So I don't see much issues with that, although I personally don't invest with that. But just once again, that's a way of thinking about those three areas. And ultimately, if you judge it, it seems like Alibaba isn't the most risky company to invest in. That brings me to the next company to talk about, which is Pinduoduo. And Pinduoduo is an e-commerce company that has been growing rapidly. And I would say here, in contrast to Alibaba, that's actually a company in the same sector with much higher risk in my point of view. So on the legal side, the China risk, it's checking each of those check marks again here. It's also in an area which is going to be more regulated in terms of how they can advertise and so on. And now at the core of their business model of Pinduoduo is obviously the topic of group buying, which they made big. It's a social event. It's a lot about what is driving the users to the platform, but this is something which the regulators have clearly at focus here, and they don't want that people are just buying because there are large incentives, large discounts, large couponing and so on, and that's all what Pinduoduo is about. And so I would say, how much is still left of this company when you take out this, because it may not go well entirely. I think there might be ways of getting compliant and not being at risk too much. but in the end, how much of the USP is gone after group buying and large incentives and couponing is actually gone for Pinduoduo, right? And then you still have the valuation risk here with Pinduoduo. It's much higher valued in comparison to even Alibaba and Jingdong, another e-commerce competitor. And then the executional risk. Well, Pinduoduo doesn't have a CFO, the CEO and co-founder just resigned. So all of that doesn't make me too much confident about this company. So once again, I'm not invested in this company, but that's how I would personally look at these companies before investing. And so I would say, well, in contrast to Alibaba, the stock here is clearly more at risk. Let's also assess some companies that I'm now invested in. So for instance, Xunlei or XNET is active in the area of cloud computing, cloud services. It's a download manager, so it's about file sharing. They are also active in the area of advertisement, and they're now also looking into blockchain technology. So this could sound some alarm bells, right? They are in the area of having an app collecting user data. They have also smart algorithms for the advertisement. Advertisement may actually see some crackdowns. But then also they have some issues around possibly the files that are being shared on their platform and so on. And who knows how the internet is getting regulated in the future. So yes, there is surely some risk around this company in terms of regulations. But then what makes me confident about it is, for once, on the data collection side, and Xunlei has actually been named by the Ministry of Information and Technology in China that they are one of the apps who is not entirely compliant with that, and they are facing a removal possibly. But I think that's a quick fix, to be honest. I think they will just make an update, and then the app is updated in the App Store and it won't be an issue anymore. But on the other hand, what makes me confident around this is, for instance, Xunlei also has an official license by the Chinese government for doing CDNs, offering CDN services in China. And that tells me that they have good government relations, something called also guanxi, or having interpersonal relationships with important players that can actually approve a company to get necessary licenses. And that's really a thing to look out for in China, because it shows directly that a company somehow has kind of, if not the support, but at least the confirmation and the compliance of government regulations there. So that's something where I think, and I'm looking at Xunlei for the core business in the CDN network and the cloud computing and the edge computing which they're offering. That's for me the most important revenue stream in the future. Advertisement could go down. I see that. There is some executional risk or legislation risk around that. But the real growth driver there, I think, has the government backing, as well as the future potential driver about blockchain technology, and I'm going to make a separate video on that, is actually one of those drivers outlined in the 5-year plans by China. And I think there are not many opportunities there to invest in that, and Xunlei is the one of it. But on the other hand, of course, there is an issue around, there is not much information about this company, so who is actually the management, how good is their technology? I'm trying to find out with further due diligence and digging as deep as I can, but frankly, yes, I also don't know them perfectly well. There might be issues around that, there might be red flags there, so that's certainly a risk of investing in this company. But what kind of balances this is, in my point of view, the valuation, because as I mentioned before, Xunlei is only valued around 260 million. They have 250 million in cash, so they're almost trading for how much cash they have in the company. It's recently turned profitable. So yes, this company could also still sell off, but at some point this valuation is becoming just too ridiculous, and maybe somebody would just buy them right out away, or at least there needs to be some revaluation happening at some point in time, right? And so on the valuation side, there is not too much risk in regards to the downside at some point is limited, whereas the upside is actually really high there. Then the next company would be ZEPP Health. And for ZEPP, of course, they are in an area with healthcare, with collecting geographical information, location data, and so on, and even heart rate, that this could be an issue at some point that regulators may want to tighten the rules here, how this data can be used. Now, on this legislation side, I think ZEPP has shown some work that they have been doing. First off, if you watch the interview with Investor Relations with Brad Sampson about how they are compliant, not only in China, but also, for instance, with GDPR rights in Europe, this company is really focused on really embracing and enforcing the rules and being compliant. And so this could also have the opposite effect, that actually an enforcement of those rules could actually benefit these companies that are ultra compliant or actually almost setting the industry standards there. And that's what I see with ZEPP. They have, for instance, also gathered a license for underwriting insurances. They have, for instance, moved their overseas data to AWS, so Amazon services, and hosted internationally or in the countries where they belong to, whereas in China, obviously, they are adhering to those rules. They have very good connections for the Chinese equivalent of FDA approval, so getting medical devices approved by the leading bodies and authorities there. And so this is a company who is actually, they know how to be compliant. So this is kind of limiting also the legal risk there in this regard, I would say. Then on the valuation risk, similar to Xunlei, and that's also why I love to invest in Xunlei and in ZEPP Health, those companies are trading once again here with ZEPP Health close to their cash position at a very low multiple regarding their sales, so 1.x multiple more or less, making 1 billion in revenues in sales but being valued lower than that. That tells me that the downside is kind of limited at some point, because investors, at some point, value investors should actually come in and invest in those companies, not even the growth investors. But the upside, I think, is huge, because at some point, if the growth investors are actually finding out about these companies and the opportunities, and for instance in ZEPP business model terms, if they become not a manufacturer but also this company that can make use of services and software, then the upsides are really big here. And so that's why I think that's a cool opportunity to invest in. And also on the management side, this company even has an American running investor relations. We have articles around the founder. It's backed by Xiaomi. Actually, also Xunlei is heavily backed by Xiaomi. So that's having some of the biggest industry giants backing those companies, which doesn't automatically mean that these companies are all good, but it somewhat limits the risk around that. Okay. Then let's talk about YouDao and TIGR, which are educational stocks in China, which have been beaten down now between 50 to 70% after last week. This news was announced, and those companies are now clearly at this China risk here with this sector crackdown here. But looking deeper now, the regulations have now been put out there, and to also disclose this, I have not an investment in any of these companies, and I'm also not an expert on the educational field in China, although I have run projects in this area, and I do think that it's an interesting area actually to invest in. But I had a brief look at some of those regulations that have now come out in Chinese, and to me, I think there might be an opportunity actually that these companies have a way of becoming compliant and still earning some money there. And also you need to look deeper into the business models of these companies. For instance, for YouDao, I know that parts of the revenues which they gather is from selling online dictionaries and also selling even some hardware, besides only providing some of these educational online classes. So, not all of their revenues are actually at risk there. So Going forward there, and I'm not going much deeper in this video right now, but I would say despite such kind of risk in those sectors, it doesn't mean that this is the end of these companies in the first place. There might be a differentiation between YouDao and TAL, and yeah, just looking at YouDao, where NetEase is a big backer, and now of course they also need to become compliant with those new rules and laws, but with such big names in the background, I think some of these companies will actually be able to renew their business licenses to still have their ICP license, and also possibly adjust their business model in a way that they can make money and yeah, kind of still remain listed also in the US. But that's for now very speculative, but obviously just giving you some idea about even within this China risk, there might be some fine print which you need to have a look at, and it's not always the end of the world. And once again, you need to look at the valuations of these companies now after they've been beaten down, and as I just mentioned, also the management, who's backing them, and the execution risk on their plans. Okay, let's talk more about two other names that I'm holding. Actually, well, just one of them right now, TIGR Brokers, ticker symbol TIGR, and FUTU Brokers. And both of these names are in a financial sector, right? So you could imagine that these are actually also in a sector that could be regulated. Here I would make a differentiation when it comes to the China risk towards, for instance, what Alibaba and Ant Financial want to do. FUTU and TIGR are basically just a broker giving Chinese access to invest in some equities. Of course, they need to become compliant with some of the regulations out there. For instance, crackdown on cryptocurrencies. Of course, they need to take off any ability from their software of being able to invest, for instance, in Bitcoin or Ethereum, if that was the case. And that's, in my point of view, something easy to do. Where they are not at risk, I think, is actually of putting society at risk in terms of that people could really get hurt taking out loans and some of that things. So if there is, there might be some pressure, for instance, on margins and what kind of things people can invest through these apps, but maybe not so much like those micro lending services, which are really delivering services that could in the end also lead to some structural problems in the Chinese economy. Okay, I just had to clear the memory from my SD card, but now I'm back, and I'm actually have added one more company that I'm going to talk about in a second. But for now, back to TIGR and FUTU. So as I outlined, yes, they are in an area which is potential at this China risk from this legislation side. So be aware of that. This is certainly a risk which needs to be managed in some way. But I would argue that they are not so much as risk, for instance, than what has happened for the Ant Financial IPO there. But also interesting here when we talk about the valuations. For instance, TIGR is much more lower valued than FUTU right now. Also, when it comes to the price to sales multiples, that has reasons in how important this company is to investors, the business model, and so on, and also how developed the company is already. So, for instance, I sold off my FUTU position because I do think that this the valuation upside has gotten much lower, right? I have invested very early in FUTU, so I made a 4x on this stock, and so now I think the downside here is much bigger, giving this China risk here, for instance, and although the execution and the management risk here is quite low because it's Tencent backed and seems to be working all quite well, and for instance, compared to TIGR Brokers, we have possibly a better management with FUTU, but yet I find this valuation risk much higher here in comparison than to what TIGR Broker here is valued, and they have a higher upside in my point of view in terms of valuation. But of course, they have also a higher risk on the executive side, and also the same risk basically on this China risk side. So for me, I decided to sell off my FUTU position. I may get back in when the valuation comes down, because I do think it's a super interesting company, but I already made a quite good gain on this company, so for me it was time to take my profits there. And meanwhile, I have doubled down on my TIGR position, but I also keep it somewhat in check. It's not one of my biggest positions there, because I do acknowledge that this is a risky play. There is a black box around the management, and it is in a sector which potentially could have some drawdowns because of some regulations happening. And although I do think they may only be short term, but the risk is real. Okay, now to another company that I've added here to the sheet, which is Beke Holdings, and they are sort of in the property area, and I have no investment in it, but I saw that, for instance, ARK Invest has invested in them. I don't know their current stake. Anyways, I got questions around this company, whether or not I would like to invest into this as well, because you know it's a big business. They're a huge platform in China, but I chose to not do that. And why is that? That has to do with the China risk here in particular, because, and I'm not an expert on property prices in China, but whenever I have been there, I was really surprised to see by what an apartment in Shanghai or in Beijing costs. And just from my personal real life experience, that I do think that housing is quite, let's say, almost in a bubble in China. Once again, not an expert in housing prices there, but to me it has this bubbly feeling, at least coming from Germany. That's why there is a risk, in my point of view, that I cannot manage, that I don't know, and where I don't want to get invested in, not even on a short-term trade somewhat. Because the thing is, this should also clearly be at the focus of the Chinese government, because if there is an issue with the housing prices and people cannot afford the prices anymore, or there is people defaulting on their loans and stuff like that, then I think there will be big issues in China. And so I do think that this is a tightly monitored sector and industry in China. And so, you know, the prospects of this platform may be really good, kind of the Airbnb of China for property buying and selling, and also having some VR stuff into it. But sorry, this is not something where I want to put my money into it, and also not knowing how to value this company, and also what is actually the executive risk involved with that. So, you know, that's one example of not making an investment in a company, and where I actually think that this whole crackdown talk and fear, uncertainty and doubt talk about China could actually be reasonable. That's not, I don't want to put you off of investing in this company, and I'm sure, for instance, ARK Invest has done their due diligence on them, and possibly it's a great company, but personally, you know, that's how I think of investing in China. This is not something that I want to be involved in here. And then, last but not least, let's expand our views here beyond China. I know there are many more stocks to cover. Maybe I do a separate video. Let me know in the comments which are the stocks you want to have my kind of this high-level judgment on these stocks. But now let's also talk about some Western stocks, which can be maybe at risk, but also some that actually could be an opportunity in this regard. So first one would be Tesla here, and there has been, and I've been talking about this here on this channel, fear, uncertainty and doubt regarding Tesla in China, and actually the same China risk applies here to NIO than when it comes to the industry and the sector. But even, you know, even because it's even though it's a Western company, a crackdown in China on regulations could actually also have an effect on the valuation or the price of a company that is actually not in a Chinese company here, because, for instance, if the Chinese government would regulate the usage of data even further, or something around electric cars even further, yes, this would have big effects not only on Tesla but also on Volkswagen, on Ford, and any other car company in China. But once again, I think the same rules apply here then to NIO. I don't think that the Chinese government is having let's say a bad view on China, that they want them out of the country. There are many positive aspects of how Tesla is actually being dealt with in China, so that's why I also have no issue with putting my money into Tesla there. But let's say now, for instance, on the valuation side, yes, I do think Tesla has still a huge upside when it comes to if they can execute on their risk. I think in the current valuation, for instance, FASD, the prospects of that are not priced into that yet fully. But the question is whether or not they can succeed with that. And then you have the management and the current technology of this company, which in my views is maybe the industry leading out there, right? So you have Elon Musk, you have their approach to full self-driving, which is far different than to what others are doing. And so they have this certain Vorsprung or technology advantage there, which makes it more, let's say, reliable. That might be too big of a term here, but the approach is very sound, in my views at least. There are others out there, I know, who would say it's totally not the case. But for me, on the other hand, there is also NIO, which is a hedge in that regard, because you know, if Tesla wouldn't succeed in becoming the first player in autonomy there, maybe it's NIO, and so, you know, I'm having both in my portfolio. But anyways, coming back to this executional risk, I think it's not as much as with other companies, but of course, because the goals and the vision is so big and so high, that's why there is lots of executional risk also involved in Tesla. So it's not an unrisky company from both the executional side, but also, of course, here from the China risk, although it's minimal on the China risk side, I would say. But then on the valuation side, as I have invested early in Tesla, and that's also why I want to get into those companies at a very low stage. Now, because I have already made all of these gains, I don't depend on that Tesla can fulfill all of their plans, right? Even if they would, you know, just become a reasonably well-working EV company in the world, the valuation would probably still be around this right now. And so the upside and downside is both there, but not as much as risk involved in that than with other companies, in my point of view. Then another example would be Apple, of a Western company that could have tremendous issues if some regulations are enforced even more, or if they are non-compliant, or if US-China tensions are getting worse. So yes, Apple also has a China risk priced into it, or maybe not priced into it yet, in terms of if there are issues evolving, this stock could be really big, heavily revalued there to the downside, for instance. So let's assume Apple wouldn't be compliant with Chinese regulation on data privacy anymore, and people would stop them to sell in China. China is a big market for them, and possibly that would have lots of sales declines connotated with the stock then, and that would obviously also have a great downside to the stock price. On the other hand, Apple is one of the most compliant companies also in China there, so I do think that this China risk is actually quite limited, and also in terms of where the companies or where the government is actually cracking down, the sector risk, they are not involved too much into sectors in which there is big changes coming, in my point of view. So that's, you know, in combination also with the executional risk, having a good management team, having a big legacy there. It's one of the least risky stocks out there in this field. But how big is the valuation upside? Hard to judge. And then, yes, the China risk has also some valuation downside to it. And then let's close it with a final example of something which is possibly not on the agenda of people thinking about the China opportunity, but also the China risk and all of this talk around it, which is Farfetch, which is an e-commerce player. And they are, well, in this premium to luxury segment. And one of the biggest customer groups is actually coming from China. And this is a company active in an area where I also founded my startup in, which is cross-border e-commerce. So that's why I know what kind of opportunity they're looking at. And they're trying to sell European luxury goods to Chinese consumer, to the middle class and so on. And so there is actually a big China opportunity aligned in this stock. This company could grow tremendously just based on selling to Chinese consumers. So maybe this is one almost Chinese stocks in this regard, right? So if China is doing well, I think Farfetch will be doing well. But of course, there are also, they have the China risk then in terms of China is doing something about the way that could affect their business model. Obviously, also their valuation would suffer, and that could be something around data privacy, that could be something in the area of how to advertise in China and so on. But I would say most of those things are actually manageable, and also Farfetch is, for instance, cooperating with some of the larger e-commerce platforms in China, so they also depend on a Chinese partner there. And so this way may actually be open till executing on their bigger plans and vision, and then execution. I think the management should be looking good there. The technology involved and the brand and so on seems to be fine. So that might be actually one of the stocks to pick where you say, I don't want to invest in a Chinese company, get me the VIE risk out of there. I don't want to have these troubles around the legal issues, but I want to profit from this Chinese market. Maybe that's one thing to invest in. Personally, I'm not invested because I kind of stay away from Chinese e-commerce. I think the growth prospects are mostly priced in many of these companies. I would rather invest in a smaller company. I like to invest in small valued companies and hopefully see them grow big. And Farfetch has already had quite a big of a revaluation and has been becoming a bigger company. It still has some upside from here, that's for sure. But that's maybe summing up things again. Looking at all of these examples, I can only give you a way of thinking about it, because maybe if you hear me talking, you also know that you can hear that I'm quite a risk taker here. So if I don't invest in Farfetch, which possibly will have a good performance over the years, but for me, I'd rather invest in something perceived risky as Xunlei, XNET, because if this takes off, it really takes off in my point of view. But on the other hand, it has also lots of uncertainties around it. So in the end, it comes down to your risk management once again, and I hope this framework with those 3 different risk factors and how you can assess them in each of those categories, I hope it can help you to better also balance your own portfolio and make the investment decisions. And on this channel, I can only speak about how I make my personal investment decisions. And many of them are risky, but many of them are also high yielding. So I hope you find that interesting. Let me know once again in the comments if this was helpful or not, and then possibly make a follow-up going deeper a little bit on this the China risk side there, and also some of these companies and maybe additional companies if you want to hear about that. So thank you guys for watching, enjoy the rest of the weekend and see you next week.